The current surge in capital expenditure by tech giants Alphabet, Amazon, Meta, and Microsoft on generative artificial intelligence (AI) infrastructure is reminiscent of past overinvestment cycles, such as the 19th century railway mania and the 1990s telecom boom. These four companies have collectively committed nearly $200 billion this year to data centers, chips, and other AI-related infrastructure, a 45% increase from the previous year. This investment is expected to yield returns only in the long term, as acknowledged by Meta's Mark Zuckerberg. The tech industry is essentially in an AI arms race. In addition to infrastructure investments, these companies have also heavily invested in venture capital, VC, for firms like OpenAI and Anthropic. Traditional VC firms have noted that they have not seen such significant corporate involvement since the dot-com boom. Despite the tech giants' ample cash reserves allowing them to invest heavily, historical patterns suggest a potential bust, which could have significant stock market implications due to these firms' substantial market influence. Historical precedents offer cautionary insights. In the early days of railroads, initial investments in tracks were rendered obsolete by more powerful locomotives, necessitating further investment in stronger infrastructure. Similarly, in the 1990s, telecom firms dramatically increased their capital expenditure and laid 600 million kilometers of cable, driven by the assumption that consumers would pay high fees for internet access. However, this assumption proved incorrect as users expected free internet. Morgan Stanley highlights a similar risk with today's data centers, which may not be equipped to handle the increasing power demands of generative AI's graphics processing units. The tech giants' expectations about consumers' willingness to pay for AI tools may be equally misguided. Current trends suggest that big tech is experiencing irrational exuberance. Projections indicate that the combined capital expenditure of Alphabet, Amazon, Meta, and Microsoft could reach $1 trillion over the next 5 years. While this might increase revenues, it will also escalate costs, including high salaries for skilled engineers and substantial electricity bills for data centers. Investor reactions have been mixed. While Google's capital expenditure plans have been well received, Meta's have not, reflecting skepticism rooted in previous costly ventures led by Zuckerberg. Another concern is the commodification of AI models. Major cloud computing companies have invested in large, proprietary AI models while also supporting smaller, open-source alternatives, such as those from Meta. Platforms like Hugging Face, which hosts over 650,000 models, exemplify the growing popularity of these open-source models. As these alternatives gain market share, the returns on investment for the large proprietary models could diminish. There is also the risk of diminishing returns with scale. Although increased computing power and data are making AI models larger, this does not guarantee proportional improvements. OpenAI's recent launch of the GPT-4o model, which is faster and more linguistically adept, did not meet some expectations for a new, significantly advanced GPT-5 model. This raises questions about whether continued investment in ever larger models will yield commensurate benefits. The competitive nature of the AI industry means that tech giants are driven by both defensive and offensive motivations to avoid falling behind. However, societal impacts may be limited, as overcapacity in infrastructure historically tends to lower costs for users rather than benefiting those who make the initial investments. This pattern may repeat with the current AI infrastructure boom.